Okay, so back with another video on the three accounting concepts that I think all business owners should be familiar with. So in a previous video we outlined the three accounting concepts that we're talking about. There is a separate video on each one. So on this one we're going to be looking at double entry accounting, which is a fundamental accounting system adopted worldwide, and it is pretty much the standard way of keeping things balanced nowadays. So we're just going to do a quick summary of all three, just so you refresh your memory a little bit. So the first one was the accounting equation. There's a separate video on that, so have a look at it if you haven't already, or if you've forgotten what it is. This one is double entry accounting, which we're going to cover now, and the third concept is the accrual accounting convention, which dictates that costs and related revenues should be recognised in the same period. So hopefully that refreshes your memory. Like I say, we're doing separate videos on each one. So this is double entry accounting. So the theory behind double entry accounting is that for every debit there must be a credit. And if you've watched the video on the accounting equation, hopefully that will make sense, because the accounting equation, assets minus liabilities equals equity. Every transaction has to increase one of those and decrease another. So that's why there's two entries, and that's why it's called double entry. So let's look at an example of a transaction. So in this instance, you've made a sale, and it's a cash sale. There's no credit terms. So the two accounts involved is the bank account, which is receiving value, and the sales revenue account, which is giving value. So now the first thing to address is that in accounting terms, when you debit a bank account, you're increasing the balance, you're putting money into it. I know that's a bit alien to some people, because in general life, when somebody says I've credited your bank account, they usually mean they've put money into it. So it's the other way around in accounting terms. So hopefully that's not too confusing. It is often confusing for people who start studying accounting, and for when I talk to clients and they've never heard of this, they do struggle to get their head around it sometimes, but hopefully you'll be fine with it. So, and obviously it's why I've used this as an example to try and get that concept out there. So the bank account, so in this case we've sold something for £450, so £450 cash has gone into the bank account, and £450 has gone out of the sales account because it's given the value. So that's it really, it's as simple as that. You debit the bank account, you credit the sales revenue account. So then when you look on your profit and loss, you'll see sales revenue there, 450, and when you look on your balance sheet at the bank account, you'll see a balance of £450, assuming that there was no balance before that 450 went in. So that's if you've made a sale. Let's look at the other side where we've spent some money. So in this case, we've had to get our car serviced. It's a company car, so the company's paying. So we debit £127 to the motor vehicle expenses account, and we credit £127 out of the bank account. As I said earlier, try and get your head around that idea that crediting a bank account from an accounting point of view means it's money coming out. So that's your debit and credit. Quite simple, there's a double entry because there has to be, what we've done there is increase an expense account. If you think back to, if you've already watched the accounting equation video, then hopefully this makes sense. When you think about the transaction types, what we've done is increase an expense and decrease an asset. So as I said in that video, every transaction in your business increases an asset, a liability or equity, or it decreases an asset, liability or equity. And then, so let's look at one more example. We've paid the mobile phone bill for 37 quid. So again, it's similar to the motor vehicle expenses transaction. It's an expense. So we increase an expense account and we decrease an asset account. So the expense account in this case is the mobile phone expenses. So £37 debit to mobile phone expenses, £37 credit to the bank account. So there's your double entry. For every debit, there's a credit. So we've fulfilled the rules of the double entry accounting system. So what that means is then, at the end of the month, once you've, this is a very slow month. We've made one sale and paid two bills. So, simple example, of course. But so at the end of that month, what we're going to do is balance off the accounting system. So the way that works is you run a trial balance, which shows you the balances on all your accounts within your accounting system. So that would look a bit like this, month-end balances. So sales revenue is a credit balance of 450. Motor vehicle expenses is a debit balance of 127, and mobile phone expenses is a debit balance of 37. And there's one more account, obviously, which is the bank account, which now has a balance of 286, and it's a debit balance because it's an asset. And obviously, if you've got a calculator there, or you can do it in your head, £450 minus 127 minus 37 is 286. So if you add up 127, 37 and 286, it comes to 450, and the sales we've made in the month is also 450. So this is how everything balances off, and the trial balance, as this bit at the bottom is called, that comes back to zero, because if you take the debits and deduct the credits, it's zero. So that is, again, that's the accounting equation in action. Assets minus liabilities equals equity. So in this case, the equity transactions is the sales revenue and the expenses, because that's income, they're expenses, and then this is part of the equity calculation. If you haven't watched the accounting equation video, that might not make sense, but it will when you watch that, or maybe watch that and then come back and review this one. So that is a trial balance, and that is what accountants work with every month when they're doing your management accounts. They basically export a trial balance, either put it into Excel or run it from an accounting system and work out what your sales were, what your expenses were, what your profit was, and everything else that goes with it. Create a P&L, a balance sheet and a cash flow statement, and then that forms your management accounts. So to look at a more complex example, because it doesn't matter how big or small your business is, the trial balance has to come back to zero no matter what. So if we look at this slightly bigger, slightly more complex example, there's a lot more sales here. So we've got, two types of revenue instead of just sales revenue, and then we've got all these expenses here, and then there's some creditors at the bottom, so liabilities at the bottom here, and then some assets here. So if you add all of that up, then it's 12,631 on the debit side, and exactly the same on the credit side, because it has to be. Because if for every debit there's a credit, then these always have to come back to zero once you net them off against each other. So I hope that makes sense. Obviously, as always, drop us a message or an email if you need help with any of this stuff, but hopefully it makes sense.